have a term that I want to make popular.
Okay.
It's called fiscal entrapment. It's the ability by the central banks to steer interest rates has disappeared because they have too much treasuries, bonds, gilts to sell. So they are incapable of steering their interest rate.
Hello and welcome to another market episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive, Onyx Capital Group, and today I'm joined by the usual macro specialist James Brody, our research associate Martha Dowding, and the man who creates the oil price himself, and new guest on the Market Podcast, Jorge and Martha. So, another tense weekend is behind us where oil traders sat and waited for the impact on the market after serious escalation between Israel and Iran. What transpired was nothing much as far as oil prices were concerned. So was the market positioned too long already, or was there not much risk at all in the crude futures? Or, and I think this is the camp that we are in, are a lot of the traders waiting on the sidelines to get max long for the middle of the year? There's a lot going on in all markets in the past week and plenty to discuss. So let's dive straight in. Martha, do you want to give us a quick summary?
Yeah, of course. I think you kind of hit the nail on the head with everything in a few words there, but there's pointers from the story itself, the market itself, and kind of the future that means that we've had this really muted response in the Brent futures. So as you can see on the graph, like throughout the week, the price was kind of oscillating around 90, closed at like $90.50, and this is kind of a surprise for anyone kind of looking more from the outskirts of the market, but it was a really muted response. And from the attack itself, we can see kind of why. There was a huge warning. Israel bombed the embassy weeks ago on the 1st of April. There was advance warning of the operation and announced it was coming and it would take hours to come. So that was another kind of thing that kind of muted the response as well. The choice of attack with the slow-flying drones and these drones as well being intercepted so well by the Iron Dome. So what does this mean? About a $1 billion cost for Israel. And as you said, the traders are likely waiting to see what happens next. The UN is calling for maximum restraint, but the Israel foreign minister is saying they're going to have a more severe and faster blow, which is kind of recognizing how the attack in the first place was a slow and not that severe blow in the first place. So the response is kind of waiting for that. As you mentioned in the first place as well, the response from the oil market was probably muted due to the kind of structure of the market as well at the moment. Looking at the CFTC report, the market is really long, especially by managed by money players, so like the funds, with the net positioning of these managed by money players in Brent the highest since September 2021. And we saw this increase in the week to April the 9th, with the long and short positions increasing compared to the previous week where it was just long, short closing, and they both increased by 13 million and 11 million barrels respectively. So yeah, they're the stats for the week from the CFTC. The Prodmerc positions are risk on again, increasing by around 8% and 4% in long and short. And lastly, for the stats, the fundamentals in the US, we saw a pretty substantial build in crude of 5.8 million barrels compared to an 800,000 barrel estimate. And refinery utilization is actually down 0.3% compared to a 0.6% increase that was expected.
Yeah, great summary. I mean, I think the interesting thing to discuss here is that over the weekend, right? This is the stuff that we've talked about a few times. There is no market on the weekend, and of course there is a lot to digest, and it's impossible as an oil trader or oil trading community to not be discussing what's going on at kind of as any financial trader would be. But in particular for oil, there was a lot of talk, a lot of expectation. I actually came in myself to the office Sunday evening for the open, and I usually these kind of things, there's not going to be much of an impact, but I was in the camp of very much expecting there to be a big impact because the market, from a data perspective, looks very strong in the underlying physical. Things are pricing very strong on the paper. So I was quite shocked to see not just no volume and no reaction. It was very surprising. Yet the Oracle, Jorge, you called it very well. So do you want to talk a bit about that?
Yeah, to us, and there is a group of older guys that I speak with, and I think we have the benefit of experience. I'm one of them. And in our views, the attack was theater. It was extremely well choreographed it was signaled days in advance. Embassies were forewarned of what would happen. Key personnel could fly out. And as Martha says, the drones are very slow flying. And so everybody was expecting the attack. Biden went to the office with his key people to see if everything would unfold as they were told to. And one of the critical delivery points was that there were no attacks on civilians. So any photo of Israel before or after the attack shows absolutely no impact on any civilian installations. So it was critically just to military installations, and it was done on the weekend. It was designed to cause no ripples in the market. It was not done on a Monday, a Tuesday, or a Wednesday. Everything is choreographed to the last bit, but it delivered some key messages. Number one, Israel is open. Attacks can come in from the outside. Even if telegraphed in advance, they still pierce the dome. Iran has the capability of targeting key installations in advance. So for Israel, it's not the same situation as it was 2 weeks ago. It has been demonstrated that they're open. But another key delivery was the U.S. is signaled very strongly, we don't want a wider war. Iran signaled very strongly, we don't want a wider war. And Israel did not retaliate immediately. Hence, the oil world is very calm right now. It is just determining whether we stay at 90, we go a little bit below or above. And in my reading of markets, if it drops towards the 85, 87, it's a very good entry point to go long again as we head into the summer, because the latest figures from China, if we believe them, is 5.3% growth in Q1. The US is going to come in at maybe 2.8, and that means more metals demand and more oil demand as we go into the second half of the year.
I think, James, we will cover that in a bit with him, but just like you're saying, this whole waiting for a pullback to buy, we were talking about this among the traders actually last week, and to me that isn't a thing, because if everyone is waiting for a pullback to buy, it's not how forward markets work. You're trading the forward markets, so things get priced in and it drags up the whole prompt. Only the physical markets can be weaker at the prompt and then be later on strong, if that makes sense. Yes. If everyone's bullish, then it should price in. So I think there's too many people saying this. It's almost very strange. Like Martha mentioned, the product merchant kind of category. This is the oil traders and end users. It's a bit of a pointless category because they chuck so many people in there. But if the open interest is going up long and short, it's telling you more risk appetite. It's telling you, well, they react more to underlying physical movements and views on physical movements. Managed money is flippant, right? And I think it's the data for last Tuesday. So we don't know what could have happened actually on the Friday. And there was a big sell-off on Friday. 91-ish down to, I think 91.50 down to 90 just at settlement. And that was, very fast money. I think, CTAs it could be people de-risking. But it kind of just shows you that the market is long. So I think anyone saying I'm waiting for an opportunity to enter has gotten very lucky, because I think a pullback is probably more indicative of the market being too long and there not being a material reaction like you're saying in the physical world, rather than, what governs a pullback to then buy if everyone's bullish. I think it's a bit cocky to say you can time that well if you see what I mean, and that does seem what the majority of the market thinks, even in the underlying North Sea markets as well. Just nothing really to say other than to make that point. But James, on the macro side then, as Jorge's saying, I mean, it's China announced that 5.3% increase, which was a pretty big headline because people have been so bearish for China for so long. Do you think this is now the time where people are going to get increasingly more bullish? And there's quite a lot to say on macro, so yeah, you could just summarize it. But
I think so. The GDP news overnight stronger than expected, and what we're seeing with that is global PMIs were in contraction for 18 months, but now we've had them 2 months in expansion. So clearly the it's slowly turning. Markets don't turn in an instant, the economies. So it is slowly picking up.
And that's it. And the data was March, right? Or first quarter.
Yes, first quarter.
And so it's lagged. And of course, it's, our year on year, I think the industrial production was down.
Mixed data.
But
Retail
it's still
sales
up.
was slightly down.
And as in it's still strong. And I think, given we're coming out of it, it's likely that the April data in May or June will be even stronger.
It's picking up, and we have the stimulus still working through from the central bank.
Right. They're very serious about it, clearly, right?
Absolutely.
They're going to follow through. Reactions in oil markets. I think the Chinese, generally speaking, have been increasingly more on the buy side. It's not overwhelming. I think there's been kind of mixed flow on crude Chinese players to Chinese players in the physical windows, at least, that Jorge set up. But it's starting to look. I mean, we kind of need a bit more. I think to get very excited about China, or at least increasingly excited from a low base, we'll need to see more evidence that they're buying into this, much more imports. Don't know if you got any points on that, Jorge.
Well, Asia is clearly growing, and China is importing more crude. The issue here is going to be the divergence between the Northern Hemisphere, particularly Europe, and the rest of the world. In another thought going through is that demand for fuels in Southern Europe is going to be surprisingly strong, because people are still in a mode of vacationing. So gasoline demand in the key centers, whether it's France, Spain, or Greece, or Italy, is going to surprise us. But Germany is going to be way behind in terms of economic performance, in terms of demand, while in the rest of the world, Middle East, Latin America, Africa, is going to surpass expectations. And hence China is going to buy more crude going forward.
And James, you were writing this morning to the trader group about the macroeconomic update, essentially, and you're saying there's signs of cracks appearing.
Absolutely. It's basically being driven by the data in the US. We're expecting the recession at the start of the year, but now we've had three key pieces of data: payrolls, then CPI, and yesterday's strong retail sales, all coming in above expectations. The key with retail sales, it tells you the consumer's still there and still spending. So yields have gone aggressively higher. And with that, the dollar's strengthened considerably as well. We mentioned last week it's at 34-year highs against the yen. It's at all-time highs against the Indian rupee. And equities have started momentum's changing equities. The Nasdaq was down, I think, 1.6% yesterday. The S&P's 4% off its highs. Tesla, one of the Magnificent Seven, is on 11-month lows. So we're seeing equities beginning to wobble.
And on the other hand, metals still having a bit of a run, right, particularly in gold and silver. That's one of your favourite topics at the moment, Jorge, right?
Yeah, it is clear that there is the risking of holding U.S. treasuries by major central banks. I have been a critic of the sanctions now for over 2 years because, number one, they're self-defeating, and number two, they hurt the sanctioner. So if you are a country that cares about not being sanctioned or to create some protection, you don't buy treasuries and you buy gold. And what we are seeing here is a central bank run on gold. And I am one of those that is not surprised if it hits $3,000, even $4,000 an ounce.
And you were saying, James, this morning banks were starting to come out and say the same thing.
Yep, yesterday Goldman Sachs and Citibank came out and revised up their forecasts. And this is when we've seen big moves already. So in 8 weeks, gold's up 17.5% and silver's up 25.5%. That's a big move already. And now they're revising up their forecasts.
Quite a lot is happening. It's almost like when we say, which we'll do in a second, about looking at the underlying oil market. If you look at the underlying macroeconomics, central banks buying a hell of a lot of gold out of China and things like that. That's quite serious things seeming to be going on. Obviously, the debt cycle is getting seemingly unmanageable in the US, but then real evidence that there's cracks appearing. So something's happening here, something's brewing. And I think one other interesting thing you wrote this morning was volatility is now starting to spike in the macro market, forgetting oil for a second, and that's a pretty big sign as well.
Yep, we mentioned a couple of weeks ago, it was at 2-year lows in bond and FX world and just off 2-year lows in equities. CPI print, we suddenly saw volatility pick up in bonds, and last night the VIX was the highest level since October.
And generally, what is this saying? I think it's fear of war, fear of US treasuries getting out of control, real moves, flight to safeties, just weakness in the dollar concept. And you mentioned Indian rupees. They're a big importer of oil. They're going to have to pay even more because of their weakening currency and because of oil prices rallying. This is a big economy we're relying on for growth. So there's just a lot of things going on, I think, is just the best way to summarize it. It's not a generic year at all, and I think the second half is going to be very interesting indeed. But let's look at the underlying market a bit more. So, Martha, do you want to talk a bit about CTA positioning actually first, something we've not done before, but we have our own internal models where, we model the CTAs, who are essentially, it's an annoying word, CTAs, commodity trading advisors, but it just means momentum traders, right, using signals, and it could be any contract. But from an oil perspective, what have they been doing lately?
So if you look on screen, you can see our modelling for the CTA net positioning. So you can see for the coloured lines underneath, we've got the Brent, TI, gas oil, heating oil, and RBOB futures, and then the heavy black line is the total, which is kind of the most important part. And even though this is the total of the other components, it's most important for when we're trying to predict kind of Brent, TI, kind of these crude movements. And it's most important when it kind of reaches these high points, because that shows when the market is most saturated by the CTA positions. And as you can see, I'll just zoom in, that we've actually started to see a bit of a sell-off since April, which could indicate that we're going to see these kind of fall through the floor. I think when we're looking at the CTA positioning, like as a general rule, we seem to see it kind of tick up and have a ticking up impact on price, and then kind of like a slamming down.
Yeah.
Whenever you see like a huge drop in prices, people are like, oh, it's the algos, it's the CTAs, when they can't really find a good reason elsewise. And I think it's just something to keep an eye on here. And I think when you mention about coming in for a good entry point for longing the market, I think this could be a really good thing to keep an eye on.
Okay, no, that's interesting. And then the actual, let's say refinery margins, what's been going on there?
The refinery margins have increased week on week, but mostly due to a really weak dated crude market. Well, not really weak, it has just weakened significantly in the week. We've seen good amount of selling continuing into today, with the BAL week being offered down and the physical diff being pushed lower by some physical cargoes being offered, and like a cargo of 40s being left outstanding, but some Midland lifted in the back, which left the physical diff lower, even with some bidding like in the prompt. Gasoline and gas oil wise, gasoline continues to rally. We saw a bit of a dip last week. I'll put the graph on the screen. But it's just, I think I'll describe it as quite a stubborn market at the moment. Even with what seems to be kind of weakness coming in, we've seen the Gulf Coast premiums weaken, we've seen premiums in Europe weaken. The market just doesn't want to be short. As soon as it dips lower, we're seeing these large European players come in and bidding it up. The market is just keen to be long here. And there was talk about maybe a correction in the RBOB screen last week, but I mean, we're failing to see it. We're continually seeing RBOB Dubai being bid, RBOB just lots more RBOB differentials than I've seen before recently, which is interesting because people want to get length in RBOB where there's not really any room, which I know we said last week we were seeing this lots of buying of the gasoline naphtha differential so that people could be long in gasoline because there's no room, but that's kind of dropped off a bit now, which could be indicating something. But I mean, even the gasoline build in the US was taken really well by the market, so
it's a really good point. I was thinking that about the Brent time spreads actually. A correction on the open on Sunday, corrections throughout the week last week, corrections now. This is all with fund rolling, which is a hell of a lot of selling pressure in the prompt time spreads, and it's with everything already quite high, very stubborn. 6-7 cents per spread at a maximum reduction, and then all the way back up, and it's there. There's a firm buyer, so I think we can quite comfortably say, given the consensus we're hearing ourselves, given the way the market's trading, it is that market wanting to be long and actually wanting to be longer, and either waiting or going to be increasingly entering now. And there's also still a stubborn belief in the market that prompt fundamentals, you should trade what the prompt fundamentals are doing. And I think whilst there's still a bit shoddy demand for crude, like local, because of maintenance, maybe to some degree, the benchmarks aren't reflecting that, but it's probably not giving the physical traders comfort to really get in, and I think that will change in the next couple of weeks. So okay, and what about the main headlines then this week for like googling oil?
So the main headlines, as you can probably predict, was just all about of the Iran retaliatory attack on Israel, and a lot of questions being asked in these articles, especially in this BBC one, as to kind of what is happening, why aren't we seeing that huge rally we're expecting? And I think if we were to see another attack on Iran, what would kind of happen with that, whether Biden would kind of support any attack onto Iran with its, oil exporting, with it being the election year and so on. Obviously, they have the sanctions against Iran, but as we've mentioned, that, only works to some extent. That's been the majority of the headlines. Interestingly, we've seen Nigeria compelling oil firms to sell crude to the domestic refineries, most importantly the Dangote refinery, which we've seen ship its first exports this week, I believe. This is really interesting, and I think it's got quite a lot of praise from the wider market as to that's kind of prioritizing domestic demand for refined products over exporting it, and it also I think will have an interesting impact on the exchange rate between the dollar and the naira, as the deals can be done in either. Obviously, we have the US dollar back market at the moment, which can see such an impact from dollar strength, especially that we're seeing now. So I think this will be a really interesting thing to keep an eye on in the future.
It is an interesting one because I think Nigerian crude oil tending to be light sweet. That is a direct competitor into the local refineries in the North Sea, Europe region. And that obviously competes more with WTI Midland. That's a staple flow from the US, Ecofis and the Osebergs. And these are all important because they price the Brent benchmark, which is pricing most of the world's oil. So taking a staple out is definitely generically bullish. But I think for traders in general, there's I guess that bit less competition for freight going in. It allows oil to move potentially more freely to replace that maybe from the US. So maybe it's bullish the exports from the US as well. But have you got any thoughts on the Nigerian situation?
Yeah, definitely. One of the things to keep an eye on or accept is that Nigeria is growing. The people there, they all want to improve their lives. They do whatever they have to essentially make some money. And it's a fast-growing country. The population is just expanding, and it is natural to expect that over time there will be no significant exports from Nigeria, and that they will continue to expand their refineries or continue to import gasoline over time. One statistic that really hits home is that there are more children in Nigeria than in the whole of Western Europe. So if you run that forward 10, 15 years, Nigeria is just going to become a behemoth. There were some reports this week, that Nigeria will become one of the top 10 economies by the year 2050. There are over 200 million people over time and growing at a dizzying pace.
And should correlate quite strongly with oil demand.
Correct, absolutely.
So I think Russia's in the past Putin's been very vocal about delivering that oil to Russia if necessary, even though they have their own. Obviously, there's different specifications, and especially the more complex, which Dangote is quite a complex refinery from what I understand. So, you're going to need to blend that with VGO from potentially Russia, heavier crudes. So no, that is quite key, clearly. And I don't know if it'll ever happen, but there are West African CFDs, which are essentially similar to in their structure to some of the other diffs like CPC and Urals to Dated Brent. They very infrequently trade. I think there was one case where BP and Vitol did quite a lot of volume, but since then it's never been a thing. But the more it trades, the more this happens, and the more there's trading into Nigeria, or at least local demand, then you could potentially have a paper market taking off there. You never know.
Markets always switch.
Yeah. Okay, cool. So I guess we've been generally very macro, but Martha, when we talk about the trade idea, you've got something a bit more niche in propane, right?
It's fairly niche. So we're looking at an arbitrage differential in propane. So we'll be selling the LST FEI in May. So selling the LST, which is a US benchmark, and buying the FEI, which is the Far East index for propane. And this basically is just looking at the differential. We're expecting this to weaken as we're expecting some FEI strength. Right now the structure's been really weak, and we've seen it start to see some support, especially this week. We've seen decent pricing in the Balmo spread. Any kind of Middle Eastern tensions coming up again would be bullish FEI, but even not, we've seen this kind of be pushed down with this growing FEI strength.
And add to that China, right? The China statistics and the growing, that's going to directly be...
Yeah, so we've seen some FEI MOPJ, which is buying likely from like petchem producers, good buying at these low levels as well. So as we've seen them more buying at these low levels, especially with the decent like kind of flat prices in MOPJ right now, that might see further support. And US structure's been really weak. The physical windows have been... the bids have been hit, flat price has gone offered, there's little local demand, and there was a draw in stocks last week which got ignored, and the market continued to be weak, and we're expecting to see more builds in the future. So bearish the spread.
I think there's so many things in this, and this is why I want retail so badly to enter this market, because it might seem like very niche, like I said, but actually it's tongue-in-cheek, because US versus versus Asia propane benchmark, it's so indicative of the world economy. One, US is a huge exporter of propane, and it's the arbitrage is always negative, or most of the time in negative territory, to incentivize those exports to head to Asia. But of course, it's a function of freight as well. If freight is cheap, then that same arbitrage level on the paper is more attractive on the physical world. So if freight gets more expensive, then of course that differential has to lower to further incentivize. And we haven't talked about freight, but Red Sea tensions this year, any kind of war scenarios, it's infrequently impacted oil in the last few years, but they will impact freight and have impacted freight. So these are the exact type of differentials that are important, because this is changing the flow of oil. So they'll need to buy more local Saudi potentially, or they'll need to buy locally, and we're talking Japan, Korea, whoever. They need to now buy local Asia. So it makes sense that FEI strengthens, and then you can extrapolate it all to, but who cares about propane? Well, propane and naphtha are competing for the petrochemical slate. Petrochemicals have had a recent increase. Petrochemicals are all about China ramping up their industrial productivity, right? This is a big sign that China are being serious. So if you're in this market and you're aware of these things, this is either a great way to reflect your view that China's on the up, or it's a great way to reflect your view on freight and world economics because of the petrochemical scenario. So I think it's a really good one to bring up. And so the only thing I would say is, from a trading kind of trade craft perspective, you put up the graph there, it's been a bit of a bumpy ride. It's got lows down to like $300 per metric ton in the past, but those kind of levels were priced in once we had Panama Canal issues, as we talked about quite a lot on the podcast. And as you can see in the graph, if it's still there, this was around December where you got the lows, and then there was a big kind of rally as the US cold spike in production regions really hurt it, and there was a bit of a bull run. But what I'm saying is like when you've had these kind of support levels in the arbitrage, it's been around minus $200 per metric ton, which is clearly the level that the Asians are very happy to buy where freight is, and buy quite a bit. So we're approaching that level again. So it's a key support level essentially where we are. So I like the trade, and I think it's one of those ones where it's a momentum trade once it keeps testing that floor. And once it goes through and the buy side hedging has been maximized for the arbitrage on a hedging perspective, then it can really start to move aggressively downwards. And you've got, especially if there's any kind of freight issues, especially if Panama Canal starts being an issue again, there is quite a bit of downside, maybe more in like Q4 you could position it. Okay. But in general, no, it's a really interesting one. Okay. And our poll last week was, which direction do you see the next 3% move going in the dollar index? That's a very macro question. It's got to be from James. And I think most people said higher. 72% said higher. You were correct. We've had the 3% move already, or was it?
We're getting there. It's getting
there.
Close. And there's going to be more to come.
Interest
rate differentials suggest that euro's going to suffer, and euro dollar's going to head towards parity.
So are we saying that cuts are unlikely now in the Fed?
Some economists are talking about possibly even a hike at some point this year.
Yeah.
I think there's underlying signs of weakness in the jobs data, but the economy is still strong. and they're not going to cut rates anytime soon.
And people love to believe, don't they? They go high, the markets do this, they go low. It doesn't work like that. It's always what the market's not expecting will create the biggest move. The market's been expecting rate cuts the whole year, even last year. So coming into this year, if there's not a cut and there's even hikes, that is an unexpected move. You should expect volatility on the back of it. But go on, you're desperate to say so.
Yeah, I have a term that I want to make popular.
Okay.
It's called fiscal entrapment. It's the ability by the central banks to steer interest rates has disappeared because they have too much treasuries, bonds, gilts to sell. So they are incapable of steering the interest rate. So the debt is what is leading us into a higher interest rate environment, as we have seen. We have these discussions internally, and I am a big-time bull for interest rates. They will continue to creep up. But as I was hearing your predictions for what is the next oil trade, an interesting one on propane, I got jealous, so I have one. It's the TI to Dubai spread. I think that spread will widen as I try to reconcile all the different.
So US crude,
ideas
WTI versus Dubai, US crude versus just for the.
Yeah, it will just widen where Dubai will outperform relative to TI.
So now
There it goes. TI is in the 85s and Dubai front end is in the 90s. So it depends which spread you're looking at, but Dubai should outperform TI.
Okay, interesting. And the high interest rates and the cycle you're talking about, that's a pretty serious scenario, though, isn't it?
Yes, because of this fiscal entrapment, the central banks have two possibilities. Sell more bonds and drive that interest rate, because as you offer more supply of bonds, the price drops and interest rates are the inverse of the price, or print more money to fund the debt. Both of those options are very bad. And so we have to face a combination of inflation and a higher interest rate environment as we go forward, as far as the eye can see. This is the fiscal entrapment. There's no way out.
On that optimistic note, we'll sign off and let you guys think about that. And thanks very much for listening. Please give us your feedback, slight changes we make every week. It's always interesting to see what you guys want to hear and like to hear or want to hear. So see you again soon. Thank you.